For the last 30 or so years, we've been in a market environment or an investment regime where stocks and bonds have been negatively correlated, meaning when the value of your stocks goes down, the value of your bonds goes up. And that sort of is the essence of portfolio diversification, and where the idea of a balanced portfolio of, say, 60% stocks, 40% bonds really came from. If you take a longer-term historical perspective, you'll notice that the correlations of stocks and bonds will go through long-term regime shifts, where there are plenty of time periods where stocks and bonds become positively correlated. And there, investors run into situations where if you're owning a 60-40 stock bond portfolio, the value of your stocks can go down and the value of your bonds go down at the same time. And so in essence, you're no longer diversified. And so taking a longer-term, more historical perspective and being aware that these regime shifts happen and not taking the last 30 years as sort of guidance for how investment returns are going to play out in the future can help you think about your portfolio differently and think about interest rate risk differently. Utilizing shorter duration strategies within fixed income that have less interest rate risk can allow that part of your portfolio to be more reliable and generate positive returns when equities fall. And the other large component of your portfolio that needs to be considered are alternatives. So investment strategies that if stocks and bonds become positively correlated, these strategies can have a zero correlation to stocks and bonds, meaning they can make money when stocks and bonds are up, down, or sideways.